The most powerful super investor in Congress, Nancy Pelosi, has been buying two tech stocks over the past month, and these two stocks are Nvidia and Broadcom. Now today we will specifically focus on Broadcom, so we will jump to our automatic stock valuation spreadsheets and plug in the ticker AVGO for Broadcom and wait for all the metrics to show up. And of course, if you want to download these awesome sheets which make evaluating any company super easy, you can always download them at my Patreon in the link in the description. Now, as Broadcom is a dividend-paying company, first we want to have a look at its dividends. And we can see that its current dividend yield is sitting at 1.27% with a dividend payout of $2.10 every single year. Now, one very important metric you always have to consider with dividend-paying stocks is the trailing free cash flow payout ratio, which for Broadcom is sitting very low at only 44.24%. And the reason why this metric is so important is that it shows that the company has enough free cash flow to, for example, buy back shares, raise their dividends, or pay back debt. So now that we've had a look at the dividends of Broadcom, let's jump to our fundamental 9-pillar analysis. And here we will have a look at the 9 most important metrics every value investor should have a look at before even considering buying a company. So right away we can see that Broadcom is quite expensive. Their PE ratio is sitting at almost 40 and their price to free cash flow sitting at almost 50. Ideally, we want these metrics to be sitting below 22.5 and below 20, which would mean that the company is trading in line with their earnings and in line with their free cash flow. Now, normally I'd be quite unhappy to see a company sell out shares, but with Broadcom it makes sense as they are currently trading higher than their earnings and higher than their free cash flow. Now, looking at the other metrics, we can see that AVGO has been raising their revenue. They have been raising their free cash flow as well as their net income over the past 5 years. Their 5-year profit margin is sitting very high at 73%. They don't have much debt at all, and they have very nice consecutive dividend growth. If we scroll down to the graphs below, we can see that their PE ratio has been rising slightly over the past few years. You can see the trend on the graph. Their profit margin has been rising as well, which is nice to see. Their revenue, net income, shares outstanding, free cash flow, all rising. Actually, if we have a look here, the net income is sitting lower than the free cash flow, which I do like. And scrolling all the way down, we can see that the quarterly dividend has been rising very well over the past 5 years, rising more than 200% in this time. The long-term liabilities are rising only slightly, and the free cash flow per share and earnings per share are both rising. So overall, we can see that Broadcom has been doing quite well. But now let's try calculating its intrinsic value. So the first thing we will do is jump to our Grams formula revised, and here we will take the earnings per share, the base PE, the 5-year growth estimate, growth rate multiplier, and the yields on A corporation bonds and get an intrinsic value of $115. Now that is 44% lower than the current trading price, which does make sense. And this is something I pointed out in the 9-pillar analysis. Broadcom is currently very expensive. But now let's jump to our second valuation model, which is the discounted cash flow model. And here we take a look at the free cash flow over the past 5 years. So we can see that the average growth rate is sitting at about 17.65%, and the analysts project a growth rate of almost 23% every single year over the next few years. So I calculated a growth rate of 18% into the future every single year. And now to move further in this valuation, we have to calculate the present value of that future free cash flow, which is the future free cash flow accounting for inflation. So we have to plug in a discount rate, which I plugged in at 7.5%, and we will calculate the present value of that future free cash flow. Now we will sum all that up, add any cash and cash equivalents, subtract total debt, and get an equity value, which we will divide by the shares outstanding and get an intrinsic value of $144.84. Again, about $20 lower than the current trading price. Now the next valuation model we want to have a look at is the multiples valuation. And here we will compare Broadcom to companies which operate in the same sector, so TSMC, Qualcomm, or Texas Instruments, for example. Now, before we plug these companies in, let's first have a look at how Broadcom compares to its competitors regarding its percentage return. So we can see that over the past year, Broadcom has returned the highest percentage from all its competitors, almost 100%, 98.95% to be specific. If we have a look at the 3 years, Broadcom has returned 239, almost 240% compared to TSMC, which has only returned 52%. And over the past 5 years, Broadcom has returned again the highest percentage, 505%, compared to the second place, AMD 376%. So this tells us that Broadcom is doing much better than its competitors. But now let's try to compare it to them using their PE ratios. So now let's plug in the competitors QCOM, TXN, and TSM. And we will take these companies' current stock prices and divide by their earnings per share to get their PE ratios, which we will average out and multiply by the earnings per share of Broadcom, which is fairly low, and get an intrinsic value at only $68.78. So you can see that although Broadcom has the highest return, they have the lowest intrinsic value compared to its competitors. So I think that Nancy Pelosi knows something that we certainly don't. But now let's move to the final valuation model, and that's the dividend discount model. So here we will take the dividend payout over the past 5 years and get an average growth rate of 39%. But as from 2019 to 2020, the growth is an outlier. We will have a look at these three, and we can see that the average growth rate would be sitting at about 12%. So I will plug that in. I will plug in the same discount rate as we plugged in our discounted cash flow model, and we will get an intrinsic value of -50, and that is because the projected growth rate is higher than the discount rate. So we will turn to our alternative model, which will give us an intrinsic value of $185.07. And now moving to our ultimate valuation, where we'll get an intrinsic value of $128.51. But I will actually go back to the multiples valuation and remove it because it is again a big outlier. And now going back to the ultimate valuation, we will get an intrinsic value of $148.42, which is still 10.5% lower than the current trading price. Now, even though Broadcom has the highest return from its competitors, I personally won't invest to it. I will rather invest into a company that is currently trading closer to its intrinsic value. And with that, if you did enjoy the video, make sure to leave a like and let me know down in the comments which company you'd like me to evaluate next.